Thank you for tuning in to another Black Ops trading tutorial. Due to popular demand and fielding a lot of questions and comments and things of that nature, I decided to go ahead and do another tutorial, giving some tips and hints and tricks and just basic market knowledge and how you can use the tools that are set before you so that you can know what to do in the market. My experience has led me to believe, and by actual doing it day in and day out, that the more simplistic the approach, the easier time you're going to have with knowing how, where, and when, and why to execute. So what we have done, and taking a show of hands in the Black Ops room, and knowing that we have a lot of new people as far as being new to the markets, new to trading and investing, I decided to go ahead and do some more tutorial to give you a better grasp of what to do and how to do it. Now, it's going to be difficult, but I'm going to give it a shot anyway, as far as order execution, because each person uses a different broker and the trading platforms there are a little bit different. Alright, first things first, let's just get into an introduction into the sheet itself. Okay. First column in column A is your ticker symbol. Okay, that's the ticker symbol that is assigned to the particular security. It may differ as far as the futures. It may differ than the ticker symbol in your broker's platform. So just keep that in mind. The next column is the security name. And what I've done is I've color coded them to give you an idea or better understanding on what's what. Such as the ones that are in blue, those are your futures. Okay. And those are the ones that I watch and trade the most. They're highlighted in blue here. All right. The next ones that are in black and white, those are your commodity futures, like cocoa, cotton, corn, coffee, sugar, those things. Okay. Then the ones that are highlighted in blue are your commodity ETFs, such as gold and silver and cotton and corn. Okay. Then we have just regular equities. Those are just regular, black and white. Then your green highlights are your long ETFs, such as the stock indexes like the Dow, NASDAQ, and S&P. And then the red is your inverse ETFs, like short oil, short gold, short silver, that kind of thing. Okay, so it's very simple. All right, the next column is column C and column N. All right, these are your pulse wave buy triggers. Okay, when the market is getting ready to create another pulse wave, you'll know on the long side, because the pulse wave buy trigger will be above your regular momentum buy trigger, or your second long. Okay. Next column is the second long. That's your 50-50 column. Okay, second long and second short. Whenever there's a buy signal, your buy signal will be here in columns E and F. Okay. Likewise for sell signals, columns K and L. Just that simple. Basically, this side of the page is your sell system, and this side of the page is your buy system, your long system. Another thing to point out is columns F and columns K. Column F and K are your key reversal buy and sell signals. Okay. When a market is getting ready to reverse, or have a high probability or possibility of reversing, you're going to get a 1 in this column here. And it's a warning giving you a heads up that the market is getting ready to do something, such as if it's been in a downward trend and you get a reversal signal here, such as like in the Australian dollar, it's telling you that it's possible that this market is ready to reverse now. It's building a bottoming process or base, and it's starting to get ready to reverse, and it wants to go higher. Okay, so that's what that is. And then here's your buy trigger right here. Column E is your regular buy signal. Okay, so if there is a reversal buy signal here, you're going to get a buy signal here. Okay, likewise on the short side, this is your sell short in column L right here. And if there's a key reversal sell signal, such as you have here in the dollar index, you're always going to have a 1 in your sell signal here. And then here's your sell trigger price to enter the market. Just like with the on the long side of the market, your negative pulse wave price trigger should always be below your normal sell price trigger. That's how you know that another pulse wave is setting up. If this pulse wave price is higher than this sell price, then you're already in the midst of a pulse wave, and this is showing you where the last pulse wave was. So if you've missed it, you'll know by how much and how far the market has moved since you had it. Case in point, the British pound. British pound pulse wave is at 159.82. Okay, today's sell signal is at 158.37, which is below this, letting you know that you missed this first one here. So here's your second opportunity to catch the continuation. Okay, next column is your stop loss. Okay, that's columns G and J. See, stop loss on all long positions, stop loss on all short positions. This is where you're going to place your stop loss. Okay. Next column, H and I, is your bull and bear market trend. If it's a bull market, you'll know it's a bull market because we'll have a 1 here in the uptrend column. If it's a bear market, we'll have a 1 here in the downtrend column. If you see a security such as the cotton ETF, you see 0 on both columns. That means you're trading inside of the Kumo cloud of death. Alright, so the market is not trending right now. It's consolidated within the Kumo cloud. So that lets you know. Alright, now this is it. This is just that simple. This is your introduction. This is your introduction to this sheet. It is very simple and to the point. Not a lot of guessing. Just let you know basically. The first thing you're looking for when you open this sheet is you're looking at columns H and I. That's where you're going to go first. All right, because you always want to be trading in a direction of the trend. So if the trend is down, like in the Australian dollar, all right, you know that you want to be looking for sell signals first. So here's your sell signal here. So you want to go ahead and sell at this price, the 103.99, putting your stop here at 107.12. And if you have a buy signal also in this column, it's telling you that if you're stopped out, you need to be prepared to reverse and go long. So that is what that is telling you. So you have a few options now at your disposal and what you want to do. You can, instead of using this stop here, you can use this buy trigger as your stop. So you put in 2 tickets. One to sell short at 103.99. If filled, put your stop at 106.37. Then you're going to place your next ticket to go long at 106.37, and then use your stop loss here to reverse and get short. Okay, that's one way you can play it. Or you can stick to the traditional, use this as your stop loss, and place a buy ticket to go long here, and then you put your stop here. All right, it's just that simple. So there are different ways to play it, different strategies that you can use. It's really up to you. You can be the traditionalist, which is what I tend to do, and use this as your stop. And then if you're stopped out, I would reverse and go long here at the stop price. Okay, that's an option that you have. And the reason why I like to stick to the traditional method is because oftentimes markets will overshoot their targets. And sometimes you get these stop runs where the market will do a head fake and reverse and hit both triggers. It'll hit both the long and the short trigger. Okay? So the way to avoid that is just to use the recommended stop. These stops are volatility based, so They can narrow or expand based on market movement. So what you can do, if you're trading with the trend, you can let your profits run. This stop will allow your profits to run. All right, you don't move your stop. You just keep it right there. So once you're in the trade, using this example, your stop stays here. It's outside of the noise. It's outside of the resistance zones. So you don't have to worry about getting stopped out, and you can just basically watch the market fall and just allow the market to do what it's going to do. And then once you're comfortable with some of the profit that you have, you can go ahead and you can move your stop accordingly. And we'll talk more about that in some upcoming videos. But for now, this is just an introduction with some basic tips on how to read the chart, how to read the sheet. All right, let's look at another example here. Let's take a look at the financial sector, the FAZ, F-A-Z. As you can see, looking at this one, if you're looking to trade this one, you would notice that you're in a bull market. Okay, it's in an uptrend. It has a 1 here in column H. The next thing you're going to note is that you have a buy signal here. Your buy trigger price to enter this market is at 64.20. The way you place your entries into the market is with stops. You're always going to stop yourself into the market. You want the price action to come to you. So you enter the market as follows. You want to buy the FAZ at 64.20 on a buy stop. Okay? If the market gaps above your stop on the open, that's fine. What's going to happen is the market's going to fill you on the opening range. All right? And then at that point, once you've entered into the trade, your stop's already going to be placed for you at this price here. So you're fine. So that way you're not worrying about trying to chase the market or what should I do. The market gapped up. It takes you with it. And that's really what you want. You want to be trading with the price momentum and the price action. Oftentimes too, and this usually happens at the end of a trend, and you have no way to determine what the bottom or the top is going to be. So what you do is situations where, let's say there was going to be a reversal, and this trend is going to be over for this ticker symbol, and let's say it's going to start a bear market. What will happen is you would be stopped out, and what would happen is you would be able to do what is called stop and reverse. I recommend stops and reverses because if you're wrong and you're trading with the trend, it means something has changed fundamentally within the technicals, and you want to be on the right side of the market. So being able to reverse your position at this support level here is critical, and or at the stop level here. Okay, that's critical because what happens is it allows you to make back some of your loss. Even if the market reverses again into the short, at least you're able to make back some of what you lost in the long position. And oftentimes too, this right here, this stop price is going to be the beginning of the next bar. So what happens is, let's say this is going to go and change into a bear market. This 57.11 stop price will end up being resistance in the bear market, and you'll be basically selling at the top of the market per se. All right, and you can just leave that stop there and watch the market continue to collapse in price, and you can add to it as you go along. So that's another way to play the sheet. So it is very simple. You don't have to do a lot of thinking. You already know that you're trading with the trend at all times. The system is going to always be either long or short. Okay, and then it looks for possible reversals. So if you're flat a market, one thing you can do is you can go in, like for example in the Ultra Dow. Today we have a reversal here, so you could go in and you could place this ticket right here to go long at 50.85 on a stop. All right, if triggered, put your sell stop here. This is and use this as a stop and reverse price. All right, because what happens is if this breakout is going to be a head fake, all right, and a bull trap, that means it's going to set up for the next leg down, and this 47.16 is going to be resistance. So you want to be short at this price. Does that make sense? And then once you're short at this price, the question is, where do I put my stop if I enter a reverse on a stop and use the stop as my entry? you use the opposite stop as your stop loss. So if you get short here when you're stopped out, use the 51.66 as your stop. And that's all we have time for today. So remember, take what you can and give nothing back.